to be a millionaire, isn't that the hope and dream of every working American who's preparing to retire? Well, what if you end up being a millionaire, but you end up being poor? And that is the subject of a recent column I found in the Globe and Mail. And it's quite interesting. Even though this is centered on Canadians, there's a lot of overlap when it comes to American homeowners who find themselves house rich and cash poor. So let's dive into this together real briefly. This is written by Rob Carrick, who's a personal finance columnist, and it was published just a few weeks ago. So the more common story, he says, is someone who begins okay in retirement, and then they find out that they're running out of their retirement savings. And so this is not an uncommon issue, as we know. In real estate, which is celebrated both here and in Canada, you can end up with anomalies such as those who are house rich and retirement poor. And this often happens, they say, because folks will buy a house, a little bit more house than they need, perhaps that dream home, but their focus is on building wealth through home equity. And so that can be found in retired households where they have a lot of equity, probably a higher valued property, but they don't have enough income to cover their living costs. An interesting letter was submitted to Carrick on the Money newsletter, and it asked if the seniors in Canada are eligible for the guaranteed income supplement if they live in a high-valued home with a lot of equity but no other assets. And the answer is yes, it doesn't impact them. Their eligibility is based on income and marital status, so that's good news for Canadians. But this is the one question that really caught my attention. And a reader with 80-something parents said that they're going to be depleting their retirement savings in just 2 short years, but they also own a home that's paid off and it's worth almost $1 million. So the reader asked, could my parents get a mortgage of about $300,000 and then invest that money to get income? Well, if they did, they're going to have to arbitrage that money where the returns on those investments would exceed the cost of borrowing that money, or should they sell and rent? So these are some of the awkward questions that are encountered when people have most of their wealth trapped in their home. And if you have money in a tax-free savings account or a retirement plan, then you can easily, transfer that money into your bank account to cover expenses rather quickly, if not in a matter of days. But there is an extreme form, he says, of being house rich in equity with not enough income. And open policy refers to this as the poor millionaire homeowner. Can you believe that? On paper, you could be poor as a millionaire. And guess what? It's happening to millions of Americans. Open policy found that in Toronto's top 50 neighborhoods ranked by average home values in 2021, they had over 6,800 people 65 and older with poverty level incomes and homes worth more than $1 million. And so this is quite interesting to see. So what are some of the options for those who have a lot of equity accumulated in their home? One is to get a HELOC or borrow against it, but that can be a challenge for retirees because that's going to be based on income. And the only other option really is just to sell the home to separate it. So Carrick decided, the columnist, to ask those in his LinkedIn community about what kind of mortgages would they recommend for a retiree. And he says the answers were not too promising because they have income requirements, for mortgage applicants. And that's, of course, what is required on a home equity line of credit or HELOC. And the cost of those are not cheap as well because interest rates have been going higher. But if we dip into the HELOC, what he doesn't mention is that a HELOC can have its credit line frozen or reduced if the homeowner or the borrower's financial situation worsens or if home values are beginning to decline. So Carrick reached out to a financial planner, Rana Beerbaum, about the 80-something parents that we mentioned earlier. A reader had written in about that who are running out of money. And here's what she said in an email. Their situation is exactly what reverse mortgages are designed for. So again, this is just a look at how people are being impacted today by having a lot of assets but very little cash on hand. And of course, it's going to take money to sell those assets or liquidate them, or you can remain in the home, get the value of that asset, and have the ability to remain there and not have required monthly payments. So again, I would encourage each of you, look for the stories in other countries about reverse mortgages and some of the challenges, such as in Canada or even in Europe, because I think you're going to find a lot of overlap. And of course, there's always lessons to be learned. Earlier this month, Realtor.com came out with their April monthly housing market trends report, and I have to say, this is probably one of the most notable reports I've seen in quite some time, so let's dive into some of the findings. First is that year over year, as measured from April to April, inventory for homes for sale has increased 30%. That's almost a third more than we had in the previous year. And interestingly, also, there's the trend that this was the 18th consecutive month of seeing inventory growth, but we're beginning to see that pace of inventory growth accelerate. Also, the total number of homes that were unsold, including those under contract, was up almost 20% compared with last year. And pending home sales and those under contract fell by about 3.2%. That's not a huge drop. And newly listed homes increased by 9.2%. Homes spent a median of 50 days on the market nationally. Can you believe that? Do you remember in 2021 and 2022, homes are being snatched up within mere hours or days? Well, those days are behind us. While all of this inventory has been increasing and quite markedly, the national median home price or list price for homes has remained relatively unchanged at $431,000. And so there is a small increase of a little over 1% in the price per square foot. And this is the affordability crisis right here. It says the required income to afford the median priced home today increased by almost $47,000 versus 2019. So what that means is that if you wish to buy a home in 2025, you're going to need to earn $47,000 more a year just to afford that home that you would have maybe bought in 2019. Of course, this is the impact of rapidly appreciating home values and higher interest rates. So this market report is showing quite a bit of activity. We're seeing increases in inventory across the nation. But let's take a look at some of the charts here. We're going to go past that, but let's look at total listing inventory. And you'll see right here, this brown line is the trend for 2025. And so it is really on a steep trajectory when it comes to the increase of housing inventory. But let's dive into some of the more specifics of the metros. And so this is where we're seeing housing inventory increasing the most. And if you're originating in these areas, you're going to want to be mindful of looking for any reductions in appraised value, because as we know, supply and demand, and as these home values as we see more homes come online in the market and stay in inventory, this will have an impact. So the Western U.S. is seeing a 41% year-over-year increase in inventory. To me, that's just staggering. The South saw a 33.3%, exactly a third more than they had in the previous year. So from April 2024 to April 2025, we saw that growth. The Midwest is a little bit more moderated, as is the Northeast. And by the way, both of those regions, the Midwest and the Northeast, are where we're seeing home values remain relatively strong, and we're seeing fewer price cuts. And we're going to dive in a little bit further to some of the metros that have the largest gains in year-over-year housing inventory growth. And look at that. San Diego, California was just down there a few weeks ago. Beautiful area, nice weather, but folks are putting their homes up for sale. And Washington, D.C., our nation's capital, up nearly the same amount, 69%. And San Jose up 67%. And then look at this. We're seeing that we have several markets, they say 20, Realtor.com says, that are now over their 2017 to 2019 normal levels of housing inventory. For example, Denver has 90% more homes than they did in the 2017, 2019 norms. And so that is showing that market is really poised for some price drops and lower appraisals. Same for Austin, Texas. Of course, that's been in the news quite a bit. The housing market in the state of Texas, they had a lot of new homes built, which really spiked inventory, and we're seeing that begin to shake out in the Lone Star State. And then Dallas as well. So we got two from the state of Texas, up 53%. So these are just some of the latest trends. Again, as always, I'm going to include a link to this Redfin report so you can dive into it. But you want to be a good student of your market, those areas in which you're originating, so you're aware of what trends are developing. And again, this could be part of the conversation you're having with potential reverse mortgage borrowers when you're speaking to the home values. Right now, they're great, but if this inventory keeps coming online and keeps increasing and increasing, then there's a very good chance that appraisals are going to begin to soften for that particular homeowner. So now I believe is a great time to get a reverse mortgage if you're an older homeowner who's looking to tap into their equity without the burden of monthly payments. And it's time once again for our monthly installment of Reverse Market Insights Market Minute with John McCue. Reverse Market Insight, if you're not familiar with them, provides the detailed data for the HECM lending industry, and they have tools that can also help you as an originator. But with us once again is John McCue to fill in the blanks on what's been going on in HECM originations and endorsements. John, thank you for joining us. Go ahead, take it away.
All right, thanks, Shannon, for having me back again this month. Really appreciate it. So just like every single month, we always start with case numbers. This month is it's kind of interesting. You know, we've talked about how HUD has been delayed in updating data. However, they have been, continually putting it out. We're still just a little bit behind where they normally have been or would be. So, here's case numbers reported for 2025 so far. So as far as case numbers, they've really been ticking up here in 2025, at least from where they ended in 24. In December, we had 2,855. We saw just over a 1% increase from December to January, and a little over 0.5% increase from January to February. In fact, for the first 2 months of 2025, new equity takeout's really been the main driver with these slight increases. As far as regional trends and total endorsements are concerned, in April we had a bounce back from March. We grew 9%. All the regions were up except for the Midwest. With regards to this bounce in case number assignments, that really has to go back to, not case numbers. The bounce we just had in endorsements goes back to the case numbers that we just spoke about. So we've been seeing kind of an uptick there. So we're seeing a slight uptick here in endorsements also. Great Plains, they were up over 66% to 45 loans. However, unfortunately, this does still remain the only region with less than 100 loans per month. New York, New Jersey, it rose by nearly 32% to 129 loans, and the Southwest Caribbean added nearly 12% to 517 loans. When it comes to the top 10 lenders, it's kind of the same as the regions. Only one lender declined in March. South River was up over 27% to 84 loans. Plaza was up nearly 21% to 58 loans, and Liberty grew 18% to 118 loans. So what can we expect, going forward? It's really a great question. And at this moment, without more case number assignment numbers, I'd only be speculating. However, since the beginning of May, the 10-year CMT has continued to rise. So with just that alone, we should expect some decline in the coming months, but how much is really unknown, as the rise has not really been astronomical. So I'd say if we see a decline, it's hopefully going to be a modest one. The other unknown out there, and Shannon recently reported on this, is the declining home values in many markets. So if rates continue to rise and you're originating in one of these declining home value markets, I'd be using this data to really help persuade borrowers to not wait any longer if they have the ability to move forward with this loan. So tune in next month to see what happened in May, and hopefully we'll have further case number assignment data by then as well.